Good morning, everyone. I think we're up and running and we're live. So thank you very much for joining us today. Profuse apologies for the delay in actually getting things kicked off. And thank you for your patience and forbearance on that one. So first off, good morning, everyone, and welcome to this latest webinar in the Swade series, focusing on topical events impacting the financial services industry. Today, we're looking at what strategies might be formulated and lessons derived from the most recent market stress events, evidenced by the failure of 4 banks in the United States, namely Silvergate, Silicon Valley, Signature, and most recently First Republic. Collectively, they provide an opportunity for senior managers to take stock and review their current processes. Undoubtedly, there will be areas for improvement as a result of these reviews, and our 2 guests today are here to talk to us about some of the key areas of focus for banks, both for review and to identify what improvements, also what challenges might be seen moving forward. So let me introduce our panelists. Our first is Dharam Singla. Dharam is member of the leadership team at ICICI Bank and has work experience over 20 years, spanning across London, Singapore, and India. He is currently designated as CFO, Company Secretary, and Head of Treasury with ICICI Bank based in London. Previously, Dharam was Head of Treasury for ICICI Bank Limited Singapore branch, and before this was Head of Desk for Asset Liability Management for the bank in Mumbai. He was a core member of the team managing liquidity for the bank during the global financial crisis of 2008. Dharam Singla is a chartered financial analyst, chartered accountant, and company secretary. Second panelist, Lakshishan, is currently CFO for State Bank of India's UK operations, SBI UK Limited. SBI is the largest bank in India. In his current role, Laks leads treasury, business planning, and finance functions for SBI UK. He's been with the bank for nearly 12 years across various functions. He led a successful new bank launch in the UK for SBI, migrating UK retail and SME businesses from branch to subsidiary entity. Prior to SBI, he was Products Director for Citi EMEA's offshore wealth management business, Citi IPB, and has diverse experience in data, technology, and project management. Laks holds an MBA from Purdue University's Cranach School of Management, and he's a chartered managing accountant. Okay, so because we're slightly behind the curve, let's press on. To start off with specific reference to the events at Silicon Valley Bank, what I'd like to do is draw a line between the processes and the individuals or people in determining the contributory factors of these failures, starting with governance, system, and controls. So, as per Fed regulations, we're aware that Category 4 banks with average asset size of less than $250 billion are not subjected to LCR and an NSFR. Similarly, interest rate risk in the banking book guidelines are subjected to the banks with 250 billion or more in total consolidated assets. But, and starting perhaps with you, Dharam, these are external regulatory metrics. Was it simply down to the bank not being subject to the appropriate mandates that prompted the failure?
Thanks, David, for the introduction. So I'll slightly develop on this point a little bit more in detail. We have looked in detail, what events unfolded behind the failure of the Silicon Valley Bank. And one can argue that, lack of the framework, which is essentially liquidity coverage ratio, which defines, sort of how much cash or liquid asset you should maintain as a bank to withstand stress on the liquidity, or the net stable funding ratio, which essentially mandate what sort of asset can be created by the bank, given the liability profile of the bank, or essentially mandate interest rate risk. Is the capital. We argue that bank failed because the regulator did not. But I have different question to ask the live audience and via CAT organizations. Though the regulator will be in there in the discussion, but isn't it the way to look at the regulatory sort of second line of defense. But the primary line, so as the senior leaders, as the management or board, what sort of measures the risk management the bank should mandate or has mandated to make sure the liquidity risk or the interest rate risk in the banking book is managed adequately?
Dharam, I'm not quite sure if you can hear me.
I clearly remember the days into.
I think we've got a bit of a connection problem, Dharam, because you're sounding very truncated.
I can hear you, David, very clear.
Sorry, Dharam. I think we better let's just see if we can get.
David, I can hear you.
Yeah.
I hope I'm audible now.
I think you can hear us, Dharam, but I believe that the connection your end may be a bit failing because we can't hear every other word that you say. Perhaps if I just sort of move away and Lax, can you test your connection? I think that we can hear you okay. Do you want to perhaps pick up on this point?
Morning, Dharam, and morning, David. Can you hear me well?
Yeah, loud and clear, Lax.
Okay. Thanks, David, for the opportunity to share my thoughts with a wider community, and thanks for the opportunity. I think regarding Dharam's comment and your comment, I can't agree with you guys more, right? Regulatory mandates cannot be a replacement for good internal controls, right, related to ALM and risk management. I think what SBB tried to do is arbitrage on the regulatory requirements by staying below the 250 billion level, right? But at the end of the day, it is down to the senior management, the ALCO and board to ensure that bank has sufficient internal governance, correct, around liquidity, interest rate risk, and capital risk. I think that's what Dharam was trying to explain as well.
Yeah.
I'm sure we can cover ALM bit in detail, but for a very layman who doesn't understand banking, it's a basic mismanagement of business and strategic risks to start with. SVB had a surge of deposits during COVID, given the tech industry acceleration and valuation. These funds, of course, were obviously short-term in nature, given the nature of requirement for these industries. They are startups. But SVB placed them in the long-term fixed-rate treasury papers, I think to probably get short-term boost to the net interest rate income. The rates were very low. On paper, these investments were zero risk from credit perspective, but this created massive gaps both in maturity interest rate gaps in the book.
Sure. And I mean, Lax, just picking up on those points, as well as the actual systems and controls being a point of failure, I mean, what lessons can we learn from the personnel and succession planning at SBB, for example, and also how the various individuals were incentivized to make some of the decisions that they made? I mean, I think that there's been quite a lot in the press to suggest that that was another failing. There was a sort of an internal mismanagement operationally from the point of view of the personnel. Would you agree with that?
Yeah, exactly, David. I think definitely, right? Because I think to me, two things come to my mind on this point, right? One, lack of CRO, for example, right? For example, they had a CRO during 20 and 21. I'm probably not getting the timelines right. So in 22, they did not have a CRO, right? So especially when just after COVID, they were massively expanding, right? And then you don't have a CRO. And obviously CRO, I think, like I would say, it's the brake in the car. You can run faster without the brake, but if you don't have the brake, it's car crash you're going to have, right?
Yeah.
And on top of that, what happened is when the CRO joined back in end of 22, he was based in East Coast, whereas the rest of the management were in West Coast. Like, how can you have the risk management, the CRO, not having not being there for most of the growth process and not being next to them?
Yeah.
And just leave the CRO. Even the qualification and experience of the risk committee was very limited. Apparently, one of the senior directors in the risk committee had experience in Vineyard, right? So what is that to do with banking? I think that is one. Lack of the proper personnel in risk management driving the business is one. And second thing that comes to my mind, David, is remuneration and incentive policies. We don't know much. Of course, we don't have much. We can't comment much. But I think if you look at it, in 21, they were under hedge, right? Yeah. But when interest rates started crystallizing, so what do you expect? That you want them to increase the hedge. But they were Instead, what they did is they sold whatever little hedge in their book, not because of the good risk management, because they were in the money. So when you are losing, rather than having a proper interest rate hedges, they actually started selling whatever hedges in the book because they were making money. It's exactly opposite of what they're supposed to do. I think the only explanation is short-term boost to profits. And coincidentally, just days and weeks before they went under, the company's top executives sold nearly $4.5 billion in company stock. The CEO alone sold $3.5 billion. Apparently, like Biden administration is looking to tighten the regulation so that there can be clawback for failed administration. But however, none of these regulations would act as a deterrent unless we have sound board and independent remuneration committee to challenge both at a management level from a CRO, but also at a board level, the risk committee and remuneration committee, which is independent. I think it looks like the board and the management is anything but independent.
Yes. Dharam, I don't know if you can hear us okay, or now you turned your camera off. We've got
I can hear you, David. I don't know whether you are able to hear me now.
That's much better. I think now that you've got the camera off, Dharam, you're loud and clear. So do you want to just sort of add to Lax's comments there?
Yeah, absolutely. Again, the point I was trying to drive home in the first point, having managed the liquidity during 2008 financial crisis, I think the lesson was learned at that point of time. That's why we had the Basel framework, which kind of, mandated liquidity is managed properly, interest rate risk managed properly. You need to diversify funding concentration, etc., etc. I mean, we need to realize that banking is a business of trust. And, to maintain that trust, there needs to be a proper framework. And the responsibility for the framework in a way lies on the board. They need to ensure there's a proper checks and balances in place, which kind of, curb the excessive risk taking by the executives, proper line of control with clear responsibility demarcated within the organization to ensure there's a responsibility and accountability at the organization level to make sure things are managed properly. If I draw a parallel to the UK regulation, we have the senior management framework in a way which kind of mandates, accountability at a very high level for the individual senior managers to make sure the business of the bank is run in an efficient manner. But again, the point I wanted to drive is that regulation is one which will evolve. But how, as a internal framework, the organization set across all these parameters kind of ensures things are managed properly. Lessons for 2008 was well learned. I think this collapse in 2023 after 15 years kind of reinforced those basic requirements to have the proper framework in place, in my view.
Yeah. I think also, Dan, the point there is that if you look at some of the information that's come through most recently and the Fed's own analysis of the events that took place at Silicon Valley Bank, I mean, they have themselves alluded to the fact that it's very difficult for them as a regulatory entity to move at anything other than a sort of glacial speed as far as trying to curb these things off. And I heard reports that there had been no fewer than 31 serious events that have been flagged to Silicon Valley Bank by the Fed prior to the failure. So, I mean, would it be a question of we're still at a stage, do you think, that the actual regulatory bodies, the competent regulatory authorities, still don't have the agility to move at the pace that they need to move at, and also perhaps the teeth to actually make their suggestions be more than just friendly advice?
No, again, I mean, so I think this incident, David, in a way has kind of highlighted why it is important, why regulator, when they are sounding off, they are really concerned. And if you don't hear to those early warnings, then what can happen? So essentially, I mean, nothing bad could happen for an organization, if it fails. So in my view, I think it's a good time for the leadership or the board to take cognizance of these sort of events and to make sure the internal framework is robust. That's the first line of defense. If that is robust, then other things will fall in place. That's my take on this matter.
Okay, thanks. That's that. I mean, one of the identified contributors to the collapse, which struck me, was the sheer speed at which events engulfed the bank, and it was simply not able to respond to the bank-run risk. I guess the main lesson to be learned from that is the diversification of funding and the risk due to funding concentration, which SVB was simply not equipped to manage. I mean, perhaps, Lax, you can pick up on that point. The diversification on the funding and the concentration risk, key contributing factors, presumably.
Yeah, I think it's exactly, you are right, David. So if you look at diversification from two perspectives, right? So diversification from like a customer segment perspective, like pretty much, if you look at here in UK, the normally banks, 30% of the deposits are FSCS insured, right? So that means the deposit. I think it's just crude way of measuring how diversified your fund is, and SVBs is less than 10%. So in terms of like more than 90% of the customers were above 250,000, right? So one, it's highly concentrated. And two, when there is a run on the bank, everyone is actually worried, like what's going to happen. It's not protected, so like you would just want to take the funds away. And those days you have to stand outside the branch to take the funds. Now you can do it 24/7 using apps and all the technologies that is available, right? And most of their clients are based in Silicon Valley, as the name says. So they are predominantly healthcare and IT sector funds, which again, if you look at, probably, let's say if they have 100 customers, I'm sure like all of them are linked. I'm sure they have WhatsApp group saying that, you know what, like Silicon Valley Bank is going down. Let's pull our funds. So it is it's not only from number of customers, but it's very homogeneous customers with a lot of links. I'm sure a lot of these equity investors, private equity firms, they are together there, right? So that is one. So if you look at it, it is a classic ALM 101, right? In terms of, look at the case study. So like it started with interest rate risk, right? So you have short-term funds you deploy in the long term. Yes, in a low interest rate environment, it works. When the rates went up, right, like what happened during 21, later part of 21 and 22, like the rates went up. So if you have, like they have, like compared to other banks, they had around 57-60% of their assets in long bonds, right? So I think it's like around 120 billion, right? So you invest 120 billion in a 5 to 6 year duration bonds. So yes, there is no credit risk, but once the rates go up, right, for every 1% interest rate, yes, they are in HTM. So accounting wise, there is no loss on paper, right? But once the liquidity risk materializes, you can't sell this. Like you are like, for every 100 million bond with a 1% rate increase, you're looking at a 6-7 billion of paper losses, right?
Yeah.
Like you can't sell them. So like you are locked in for like yes, it is US treasuries, but you can't sell them. So you have an interest rate risk, you have losses coming in. So like if you need to sell those papers, you kind of end up in capital losses. I think there is an article in FT, David, I think very interesting. I'm just gonna look. I think what they did is they actually plotted all the major banks in US, and then they said what is the capital ratio of those banks, right? So SVB's was around, the CET1 ratio was around 13%, which is not very far from the rest of the peers. But what is interesting is once the HTM losses are taken into account, obviously HTM losses are not considered for CET1 because only AFS is considered. Once that is considered, their CET1 ratio went down below 1%. So that means if you need to sell, you kind of wipe out all your capital. And when the liquidity actually goes out of the door, you have all capital is wiped out. So it is a I think every bank, as I said, every bank should discuss this in their ALCO and senior management for the lessons to learn and how they can manage it better.
Yeah. No, thanks for that, Lax. I mean, Dharam, have you got anything to add as far as that liability mismanagement?
So David, perfect. So slightly different perspective, I would like to highlight here. I will quote some numbers just to set the context. we all know that Silicon Valley Bank in a span of 2 years, let's say 200 billion roughly in a matter of 2 years, and we know that out of that balance sheet of 200 billion, there is a 170 billion of deposits which are contributed by short-term funding in the form of demand deposits. And interesting to note, out of that 170 billion, 150 billion is given by 37,000 depositors with the average size of 4.2 million. So in a way, you have a liability profile which is very, very new, short-term in nature, highly concentrated, geared towards certain specific sectors. Now, I understand banking is in the, banks are in the business of accepting deposit. You can't, beyond a point, regulate what sort of money comes in. But what you can regulate is what sort of asset you create. That's really important. And that is where the liquidity and interest rate risk framework comes really handy in this kind of a scenario. Let's say if you have a proper framework, just let's say if we think through, if given this kind of framework or the profile of my liability, if I'm a balance sheet manager, will I be able to create 100 billion 6-year securities locked in at the rate which are very low? And what happens when the rates goes up? That's what Lax was highlighting. You end up having mark-to-market losses which are significant and which kind of wiped out your entire capital. So the point to note, in banking, we always say that liability is your true asset. Liability will decide what sort of asset you can create, and there is nothing wrong or right, but needs to manage properly, risk profiled properly. Basis the liability, you profile what sort of asset you can create. In this example, continuing with the example, let's say if the executive management had a proper framework in place, I'm sure the framework would have restricted creation of this 100 billion 6-year assets in STM. Then the framework might have mandated that, your liability profile is very, skewed, highly concentrated, is short-term in nature. Please put a lot of money in liquid cash, balance it with central banks, etc., which can be used to repay if these customers come to withdraw the money. So going by the same example, has this 100 billion put in cash or let's say short-term treasury bills, 3 months, 6 months, instead of 6-year mortgage-backed securities, they could have very well a scenario where the bank failure could have been avoided. So this examples clearly, this demonstrate very clearly how important is the risk, the interest rate risk management framework. These are very basic things. In good times, these frameworks looks very restrictive to us. Say, it's very costly, but how effective it is in a time when the market is quite volatile. That's the whole point I wanted to highlight.
Okay, thank you,
David. Just to highlight one thing that Dharam mentioned, right? I think obviously two things happened during this period, right? One, a significant growth in deposits, as Dharam was alluding to, right? I think they kind of grew by like 80-90% year on year, which is a significant growth, where like rest of the banks, rest of the industry is growing probably at a single digit, right? So when you have such a good high deposit, I think that is where that should act as a red flag for you, right? I think rather than relaxing some of your risk and governance, I think that's where the risk and governance framework should be strengthened. Whether can you run at that pace? Can you run at 90% year-on-year pace? And do you have the controls and the risk management framework in place? And you lost the CRO at the crucial time. And so do you have alternate arrangements to put in place that you have a sufficient challenge, independent challenge provided at the management and the board? I think that's probably a combination of ALM mismanagement plus proper sufficient control. I think that's what probably pulled them down.
Okay, thank you very much, Lax. I mean, we're overrunning slightly, gents, obviously, as we started somewhat late. So just to sort of finish off, I think you probably sort of summarized what you think are the major sort of takeaways as far as Silicon Valley is concerned, and indeed some of the other banks that were sort of introduced at the beginning of the webinar. if you were to sort of summarize perhaps 2 or 3 key takeaways from this and how those could be applied to any bank, regardless of jurisdiction and regardless of the competent regulatory authority that has jurisdiction over the entity, what would they be? Dharam, do you want to kick off on that? Just a couple of points, 2 or 3 to finish off on.
Yes, sure. So I just want to highlight banking is business of trust. If the trust is lost, we have seen what happens, the organization fails. So in order to maintain trust, I think it's the duty of the board and the senior management to ensure that proper risk management framework is in place. Obviously, we are discussing today about liquidity risk and interest rate risk. It also boils down to other risks like credit risk, operation risk, etc. And the framework should ensure the risks are measured, monitored, managed, and excessive risk taking is curbed. Executives at the risk management are kind of empowered, and you should not be able to change the rules depending upon your convenience. I think good times people tend to relax things, which becomes very problematic when the markets become tight. I think having a framework which tests the time is the key in my view.
Thanks, Dharam. Lax, what do you want to add to that?
Yeah, just to add to what Dharam was saying, right? I think trust is important, right? But when banks have, like any bank with such a liquidity run, no bank will survive that, right? So that's why I think in good times you need to ensure that you have proper controls in place, right? Irrespective of the regulatory requirements, I think it is more relevant for UK now, right? Because PRA is looking at having a simpler firm regime. So forget what regulators want you to do. You need to understand your business, you need to understand your model and have proper controls in place that manages your business model, right? And I think I would add one more thing. For every bank, I think there is enough material about SVB out in the world, right? To just take the learnings from SVB, why it failed, right? So is it relevant for me, for my bank? And do I have the measurements to KRIs to monitor those things, whether it is concentration risk, whether it is FDIC limits? So just ensure that you have those measurements to monitor whether it is ALM, whether it is risk management, or you monitoring them. That's what I think is key. Thank you, David. Yeah.
Okay, thank you, Lax. Gents, thanks very much for your time. Apologies to everyone who joined the webinar for the delay. I hope you found the comments and reflections of both Lax and Dharam of use. And let's all work together to make sure this doesn't happen again too soon. So, guys, thanks very much for your time. And thank you, everyone, for joining the webinar. Keep looking at the Suede website, and we'll be sending out more information as far as future events like this. So, again, thanks, everyone, for joining. Bye-bye now.
Thank you. Thank you, Dharam. Thank you, David. Bye.
Thank you.
Thank you very much.